Good afternoon, team. All right, interesting things going on in the market as usual, probably more interesting than usual right now here in the San Diego market, and especially across the country, really. We're experiencing the same supply issues. Inventory is the story. I'm going to give you a quick update today on the San Diego market. We're going to look at homes. We're going to look at rates. We're going to look at data. We'll do it quickly so you have an idea what the heck is going on and what to expect from here. The big news yesterday was the Fed making their announcement. They had a 2-day meeting. They came out and said, yes, we are going to raise rates. A lot of people believe they're going to raise rates at least 3 times this year, could be 4, and some people are even saying 5 times to combat the inflation that we are currently experiencing, which is the worst in 4 decades. So inflation is not good for mortgage bonds, which determine mortgage rates, and that's where we'll start our discussion today. Derrick Evans here, NMLS 155010. Call or text me if you have questions about buying, refining. Always email me if you need me. Okay, so let's get my mug out of here. Let's get this off the screen. And we're going to start over here at mortgage bonds. And this is the most important chart of the days that we are in right now to try to figure out what is next for real estate. A lot of people believe that if rates go up, that prices will go down. Historically, this has not been true. In fact, it's quite the opposite. When rates start to rise, people become more frenzied because they're worried about getting in before rates go up even further. And we're seeing that happen right now. So in general, we're looking at this graph. We're seeing, okay, prices, these are candlesticks, daily candlesticks, prices are going down. When prices of bonds go down, the yields attached to them go up. Those yields are rates. Those are what make mortgage rates. So when bond prices go down like this, rates go up. You can see here recently it's been particularly violent into the downtrend, and that is kind of what we are experiencing at the moment. Conventional rates now a lot in the mid to high 3s. You're seeing VA rates now high 2s to low 3s. That's the best case scenario. Same thing with FHA. Jumbo rates getting up there as well into the high 3s. Mid to high 3s and even low 4s in a not perfect scenario. So you're seeing rates about 0.5% to a full percent higher than they were just a few months ago, which is pretty wild to imagine. But this is going back here just to September. You can see we had a really nice range back here of high bond prices, and we've just lost a lot of ground. We had this trend here, and then we had this more sharper downtrend here. And now we've finally gotten to a place. I'm going to go ahead and just refresh this page as opposed to trying to delete all those individual lines. We now have a situation where if we just look at the last several business days, and we kind of have to, we have to include everything, but if we take with a grain of salt that yesterday, which was this bad red candle right here, that was the Fed day. We lost 70-some basis points yesterday. I think it was 72. Outside of that, we had 1, 2, 3, 4, 5 green days in a row, and then we just gave it all back. As I was mentioning a couple of days ago, this is sort of the perfect situation for the downtrend to continue. This former support line here, where we got a small bounce off of it, becomes resistance now, and we kick off of that. So we were expecting that. What we can hope for now, the best case scenario, is that we create a new range, and we stay right in this range for the days to come. That's the best case scenario, is we're not going to go higher. Bonds are not just going to magically run away higher here. That's just not going to happen. We need what we have going on right now, which is trouble in the stock market. We've seen the last few days, if you just look at the closing prices, it doesn't look like the stock market has moved much. But if you watch what happened intraday, or if you look at the charts, you can see wild swings. The last few days, the Dow, this is the 3rd day in a row, we've had almost 1,000-point swing from top to bottom, yet look at it, it's closing almost flat. These are bad signs for stocks. Okay, now that could be the one thing that saves us over here. If the stock market really gets pummeled, a lot of the fund manager old money will go into bonds as a place to park their cash in the meantime. And so you could see, bonds be the beneficiary of a bad stock market, which I believe is on its way. Remember, when the Fed cuts rates, stocks go higher. So when the Fed raises rates, stocks do what? They go lower. And that is where we are right now. And while there are still some good companies making good money out there, producing good things, and we have sort of a pent-up economy, from the pandemic and everything. It's very pent up. It feels like it wants to explode. Like if the president came out and just said wide scale, reopen everything, COVID nothing, you would probably see another huge surge in stocks and the economy would go off. We did get a 6.9% GDP growth to close out 2021, which is stronger than expected and actually is pretty good. But if you compare that to our 7% inflation figure, which we all know is well below what it actually is, and this is probably, if anything, this is skewed higher, it's really not that great. And so there's just a lot of back and forth and mixed emotions there. So our best case here is that rates will stay kind of where they are right now. For the pre-approval that you might already have, if you were pre-approved months ago, you may want to check back in and, let me know, hey, what do rates look like now? Have things changed for me? It's never a bad idea to do that if it's been a while since you've been pre-approved. Also, sometimes, people get raises, things like that. Take a look. Maybe you're pre-approved for more. You might need it. As we look here, the inventory is very, very slim. I did a search here. This is on Redfin, just for, quite simply, 800,000 or less, detached house, 3 bedrooms, 2 bathrooms. That's it. That's all the filters I put on there. And this is what we have. Not a lot. What's interesting to me, though, is that not that long ago, a much higher percentage of these homes would be hot homes. And you can see the ones that have the little orange marks on them. Those are hot homes. And so there's less of those now as a percentage than there was recently, which tells you a few things. It tells you that sellers have caught up to the market, that they're pricing things where they want them to end up, which is a terrible strategy. Sellers, don't do that. Listen to your agent, for goodness sakes. But every single one of these homes would be hot if priced appropriately and would maximize their potential value. As buyers, it's good to see this. It's good to have someone list a home. I don't want to pick a listing and make anyone mad, but here's one. 600,000. Okay. That's not a hot home. And so it's probably not getting the activity it could. Pictures are kind of weak. It's not updated. Those kinds of things. That is now opportunity for buyers because it's not gaining attention. It probably doesn't have multiple offers. These homes that are hot, they probably have multiple offers. They could be going for, in some cases, 6 figures above list. So, that's kind of, you have to flip your mentality with it a little bit and go, you know what, the ones that aren't hot, those might be the ones where the opportunity is. The ones that are hot, they're going to go for way over list. Like this one here, 675, this could go for, mid 7s. Totally possible. So these ones over here that aren't, maybe they go for under list. So whether it's a hot home or not, it's not a guarantee, but it just lets you know what's cool about Redfin. They let you know that, hey, this home is being looked at by a lot of people. People are coming back to this home. We're getting a lot of views on this. That signals to us typically that, this home is going to sell quickly and with multiple offers. So thin. And if we go to the data, I decided to do the data second because usually I would do the data first here and then we would look at homes. We're going to go to the data second. Now you've seen it on there, all right? And I went to 800,000. Back in the day, I would do this search to 600. Just a couple years ago, I would do the same search to 600,000. If I did that today, there would be almost nothing on here. Let's do it just for fun. And there used to be plenty. Look at that. There's 3, 4. Not much at all. Even if I zoom out, just nothing. So inventory is the story. And here's the market for inventory going back 3 years. Okay, so we're going back to 2019. And you can see in 2019, we had approximately, let's call it 1,100 homes on the market here in San Diego. Today, we have 300. So that is about a quarter, about 25% the number of homes for sale now versus 3 years ago. 25% as many. And we have more households now. We have more demand now. Pretty wild. We have lower rates now. Even though rates have gone up, they're still lower than they were back then. So that kind of just tells you, all right, that's what's going on. It's an inventory situation. There's less and less people want to sell their real estate. People have figured it out. It is a great investment. Long term, it works. Tax advantages are great. Here's price per square foot in San Diego. And you can see over the same 3-year mark, price per square foot here has gone from 450-ish, 460 to 650-ish. So a couple $100 a square foot. That's pretty darn good, right? It's a very nice curve here, very steadily growing and heading higher. I think we're going to expect that trend to continue for quite some time. But you notice how the two coincide. Price per square foot inches up nicely as it will allow me to do that. No, I guess it won't. Inventory goes down. That's really the whole story here. So expect rates likely to go higher, prices likely to go higher this year, and inventory is likely to decrease. So all like bad news for buyers. I have no good news for buyers. Other than all of the things that are good about real estate, those are always good, regardless of the market. Tax advantages, hedging your housing costs, principal pay down, opportunity for appreciation. Those are all things you get when you own a home that you do not get when you rent. You get 0 on all those when you rent. Also, P.S., rents going way up. That is one thing that, like, look at the median rent now, versus a few months ago, gone up another $100, up to $3,400. So we're going to continue to see rents go up. You're going to continue to see prices go up on real estate. You're going to continue to see rates go up, most likely as well. Our best case on rates is that we stay in this range right here, and we continue to just kind of go back and forth in this range here for a while. And we would need the stock market to feel some pain like it is today. We would need that to happen in order for us to get that good luck, best case scenario on rates. So hopefully that's what we'll see. Hopefully rates will stay right here and we'll get a little bit of a breather in the real estate market. We'll get a little bit more of a balancing act going on. But as of right now, still a strong seller's market here on the market action index. And 87 is very, very high. It's peeling back a little bit from last month at a 91, but still very, very much a strong seller's market. And that is the trend that will, I can almost guarantee you, continue. So hopefully this is helpful for you. Give me a call if you have questions. If you need anything, just let me know. I will be here. Call, text, email. Have a great day, and I'll talk to you soon.